For years, the Indian chemical sector was treated as a monolithic engine of growth. If the market boomed, the sector boomed together, moving as one massive, predictable block. We're talking about an industry anchored by heavyweights, companies like RT, Atul, Deepak Nitrite, PI Industries, and SRF. Together, they represent billions in market capitalization and power supply chains worldwide. But that unified front is gone. The market has violently fractured into two different realities. Bulk manufacturers like Deepak Nitrite are seeing massive profit upswings and expanding margins, while specialty producers like PI Industries watch their margins collapse. To understand why these local companies are suddenly on opposite trajectories, we have to look outside of India. Their balance sheets are actually being rewritten by a massive strategic pivot happening over 2,000 miles away. That pivot is a new policy push in China, known as anti-involution. For years, Chinese chemical manufacturers engaged in cutthroat domestic price wars, fighting each other to the bottom. The government and industry leaders are now actively forcing an end to that cycle. This policy dictates that Chinese factories intentionally reduce their excess manufacturing capacity. They are no longer flooding the global market with cheap, basic bulk chemicals. This chart illustrates the immediate macroeconomic effect. As the global supply line shifts left, representing that reduction in Chinese output, the baseline price for basic chemicals structurally resets to a higher level. At the exact same time, recent conflicts have caused physical damage and sudden operational disruptions at major Middle Eastern chemical plants, choking an already tightening global supply chain. This dual supply shock creates a perfect environment for the companies making the exact chemicals the world is suddenly short on. Indian-based chemical producers, specifically companies like Deepak Nitrite and RT Industries, are stepping in to fill the void. They are running their plants at higher capacity, and the gap between their raw material costs and final selling prices is widening so much that some specific product lines could see their profitability double. The profit boom in the bulk sector is the direct, mathematical result of constrained global supply entering a true upcycle. But China's anti-involution strategy has a second, much more destructive half. While they are stepping back from basic bulk chemicals, they are aggressively pushing into higher-tier, value-added specialty molecules. They have built sprawling new facilities specifically designed to dominate this space. The sheer scale of this infrastructure is now flooding the global market with specialized chemicals. This chart shows the pricing for a key agrochemical called pyroxasulfone. While the Indian market price has hovered around $70 per kilogram, the flood of Chinese supply has caused their selling price to plummet to $40 per kilogram. And while their final product prices are crashing, these specialty manufacturers are simultaneously dealing with severe inflation for their raw material inputs, like methanol and sulfur. This creates a brutal margin squeeze from both ends. Companies highly dependent on complex agrochemicals and fluorochemicals, specifically giants like SRF, PI Industries, and Novin Fluorine, are absorbing the full brunt of this dynamic. While the bulk chemical makers enjoy a lucrative boom, the specialty manufacturers find themselves trapped in a product-specific oversupply crisis engineered directly by Chinese expansion. China's decision to restrict bulk dumping while deliberately dominating specialty molecules is a multi-year structural trend. This is a deliberate repositioning of their industrial base. For investors, the era of buying a basket of generic chemical stocks and expecting them all to rise on the same tide is over. This matrix breaks down the framework you actually need now. On one side, bulk chemicals benefit from tight supply and margin expansion. On the other side, specialty chemicals face rampant oversupply and severe margin contraction. Of course, this trajectory carries macroeconomic risks. If China abruptly abandons its production limits and resumes dumping, or if there is a severe slowdown in global demand, this entire equation could flip again. Keep in mind, the information provided here is for educational and informational purposes only. It is not financial, investment, or trading advice, and you should always consult your financial advisor or do your own research before making investment decisions. Navigating the future of the Indian chemical market requires looking past local borders. To understand exactly where these companies are going, you have to follow the geopolitical mechanics of global supply.